Good evening, ladies and gentlemen. A very warm welcome to FSMOne.com's flagship event, What and Where to Invest 2021. This year, FSMOne.com intends to help you put together your investment survival kit to ensure that you survive and thrive in your investing in 2021 and beyond. We have a lineup of online presentations today, as well as on the 26th of January in the evening from 7 p.m. to 9 p.m. Over this series of presentations, we'll cover various topics to put together for you a suite of survival kit items and the respective tools that will be helpful to you as an investor as you navigate new market conditions in the coming year. In this session, it is also your last opportunity for you to accumulate chances throughout the session for our lucky draw happening later at about 8:45 p.m., where the grand prize winner gets $1,000 worth of FSMOne auto sweep account credits, and 10 other winners will also receive $100 worth of FSMOne multi-currency cash account credits each. To be eligible, head to Event Live via the link in the confirmation email you received when you registered for the event. Remember to use the same name or nickname and email address each time. To accumulate chances for the lucky draw, there are several activities you can complete. You can log on each day until today's session. You can also participate in the daily quiz. You can also complete and submit the survey by today. Or you can visit our partners' pages. They are Nikko AM, Schroders, UOB AM, and Allianz Global Investors. You can also share this event on your social media through the social media buttons on the footer. Today, we have our final daily quiz where we'll be giving away $100 worth of FSMOne multi-currency cash account credits to 3 lucky winners. Remember, you have to be accurate and fast to win. We have also already opened up our survey where you can submit your feedback on this event. We would love to hear about your experiences, so to complete the survey, click on Survey in the menu below this video. Do note that by completing the survey, it also contributes to your chances for the lucky draw later this evening. If you're wondering what this 3D rope represents, it is a key item in one's survival kit and also outlines the theme for today's presentations. As FSMOne.com celebrates our 21st year in 2021, we believe investing is a way to help everyone achieve financial freedom, especially for those coming of age and beginning their journey of adulthood. Let us show you the ropes and prepare you for the long and sometimes arduous investing journey ahead of you. As we gear up for the start of the sessions, you may have noticed that we have opened up a poll for today. So do interact with us and other viewers in sharing your experience and opinions in the polls. To participate in the poll, firstly, click on Event Activities on the menu below this video. Under the agenda, look for the poll schedule, then click on the Join Poll button. The poll window will be displayed on your right. Ready? Let's start the poll. Question 1. What age were you when you first started investing? Here we have 55% voting 21 to 30. So I guess the majority of us started in our 20s. And question number 2, which type of products did you buy into when you started investing? If you have not started, which are you most interested in? We have stocks, ETFs, unit trusts, bonds, insurance-linked investment plans, or others. Please share your preferences as we would like to know. Most of us are interested in stocks. Interesting. Our last poll question, which markets did you invest in when you first started investing? If you have not started, which are you most interested in? Singapore, the US, Europe, China, Asia, emerging markets, or others? 54% of us are interested in Singapore. Thank you so much for participating. And with that, let's kick off today's first presentation with Jean-Paul Wong, the General Manager at FSMOne Singapore. In this session, he will share how he started investing in his 20s and why he stuck to it despite many roller coaster rides the markets have gone through, and the strategies he has in place to achieve his life goals.
Hi, good evening, everybody, and thank you, Geraldine, for the introduction. So I'm JP, and today I'll be sharing with you my presentation in terms of how I started my investment journey. So just like the markets, this journey has seen a lot of ups and downs. Along the way, there were euphoric moments where nothing seems to go wrong, only for Mr. Market to remind me otherwise. And even now today, with a lot more white hair and wrinkles, I am still learning new things from the markets. I started working in the second half of 2003 as someone who just joined the workforce amidst the SARS situation and pandemic back then. My main priority was to take the first job offer that came, save up and build up some emergency funds. The fear over SARS and what this meant for the economy and jobs also led to me actually not prioritizing my investments. But I finally made my first investments in March 2005. Which is actually in the age bracket that the majority of investors just now are in for their first investments when they took the poll. So no surprise there perhaps, for my first investments, they were actually via Fundsupermart, as FSMOne was known back then. I thought I bought an Asian equity fund as my first investment, but when I was doing this presentation deck, I actually checked my investment account and historical transactions, and I found out that in 2005, I was in a very pro-China mood. The first investments I made were in free funds, all invested into China, Taiwan, and regional China. As you can see, my concept of diversification was non-existent. So back in 2005, the long-term case for China was solid, and even today, I am still very optimistic on my China investments despite all the troubles we have seen in the last few years, what with the US-China trade war and the battle for dominance in technology and other fields. Strategy-wise, looking back, I didn't have any, but it did turn out to be profitable investments, and I took profits around 2006. Investing to me was about taking short-term profits back then. The concept of every drop adding to an ocean was something important to me. Of course, in hindsight, if I had taken a longer-term view and outlook, I would have done better, I think. So, of course, past returns are not indicative of future performances, but if you look at this table on this slide, you'll find that the Regional China Fund here from SSA would have given a decent return if I had held it over 10 years, an annualized return of about 10% in fact. And that is an annualized return I would take any time gladly. But one thing I learned is that markets don't stay down forever, nor do they go up forever. So if I look at this slide, which represents the Asia ex-Japan market, I think that really explains and sums it up very well. So when I look back, the post-SARS period was actually exciting because that was the beginning of a golden bull run era for Asian markets. The 2003 to 2008 period, as you can see, meant that investing in single markets and Asian markets was actually quite easily profitable. But as you know, when things are too easy, I think you will agree with me that we don't take away very useful lessons from the experiences. And the excesses leading up to the dot-com bubble of the late 1990s, as well as those leading up to the great financial crisis in 2008, I think those showed us clearly that when there is too much exuberance with little disregard to fundamentals, things will end up badly. And as we all know, they did end up badly in the GFC period. Many markets fell by over 50% in a matter of just a few months from the 2008 peak. I did not sell all my investments back then and somehow stayed invested mostly in Asia. The GFC downturn was painful, but recovery did come, as we can see again on this slide. But it was not a bed of roses. Along the way, there were bumps. So for example, in the second half of 2015, the China markets fell off the cliff. Asia was not spared because of the growing prominence of China. But again, there came the recovery until, of course, the COVID-19 situation happened last year. But in a very surprising twist, there was a swift downturn followed by a very swift recovery, as we can see from the slide. So here I use the example of one fund that I've been holding on for a long time, probably the longest in my portfolio, which is the Dividend Advantage Fund, an Asia Pacific ex-Japan equity fund. So over the last 10 years, the annualized performance of this fund is roughly about 9% per year, which is superior to the 7.4% for the FSMI Asia ex-Japan index. So this FSMI index is basically an aggregate of all the Asia equity funds distributed on FSMOne, and superior, of course, to the 4.99% from the MSCI Asia ex-Japan index. What I wanted to share with you here is that in some markets, such as Asia ex-Japan, there are some fund managers who can outperform the indices over time. Of course, I should also add that depending on the time periods, so if you look at the shorter time period of, let's say, 3 months, the funds may not outperform the indices. But given a longer time frame of, let's say, 3 years and more, the better managed funds and regions such as Asia and emerging markets, they can outperform the indices. So I think if I recap, investing in my 20s can be summarized basically in 2 points. First, I had a very short-term outlook. Second, I had zero diversification. Strategy-wise, I needed something, an investment plan with a lot more steps and discipline. And that is something that I hope I can share with you over the next few slides. So first point, what's the real purpose behind investing? I think back to the main topic that I was given today. So why am I investing? The obvious reason is to make more money. But I think we should link that to our different life goals. And here, I'd like to bring up the concept of having different buckets for different life goals. So at different times of our life, we will have different priorities. But one of it never changes, and that's the ability to have some emergency funds that are liquid but can comfortably beat the terribly low interest rates that we get from our savings accounts at the banks. So bucket one, I'll call that the emergency funds bucket. Depending on our lifestyle, some of us may want to have up to 6 months, all the way to up to a year of emergency funds that can cover our monthly expenses. The other buckets, depending on what stage of your life you're at, it can be a marriage bucket, and usually that comes, of course, with an expensive purchase, which is your first home purchase. Other buckets can also, of course, include a retirement bucket. So going back to this second tip two, I just wanted to draw your attention to something that happened on day one of our What and Where to Invest 2021 event. We did 2 polls back then, and in one of the polls, if I recall, 50% of you said that you didn't catch the market bottom in 2020. And I think the bottom was roughly around March of last year. In a second poll, 80% of you said that your portfolio was making money by the end of 2020, which is great news. So just based on these polls alone, it shows that catching the bottom is not a must to ensure that we're making money. Of course, there's a lot of excitement and bragging rights to tell our friends that, hey, I caught the market at this bottom. The truth is, we cannot do it consistently. And as investment guru Peter Lynch says, far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. So if you look at this slide and this chart, we'll find that over a period of slightly more than 30 years, it is actually better to stay fully invested. And the reason is, and the key point here is simple, because markets move really fast. And if you miss the top performing trading days, the portfolio would end up worse off. And that is essentially what we see here for 5 major equity indices. So there is wisdom in the saying that time in the markets beats timing the markets. History shows that markets go up and down and not in one straight line. I like to make references to Howard Marks, another investment guru who wrote the book Mastering the Market Cycle. So all markets go through cycles. So he used the example of how markets swing like a pendulum from left to right and rarely stay at the center. What this means and what this table shows and supports is that markets who end up as a winner in one year will not necessarily end up winners every year. So in the year 2017, for example, as you can see, the US market was bottom of the list, but the next year in 2018, it ended up as the best performing market, albeit of course with a negative return because 2018 was a tough year for equity markets. Having said that, if you look at the table closely, the digital economy did very well in the last 4 years, which is a reflection of how much things have changed for the different sectors within digital economy and how they have progressed and innovated, and also how investors have been willing to pay a premium for that. And that accelerated even further in the COVID year of 2020. So the key to navigating through market cycles is diversification. Here, let me start with one form of diversification that is at the asset class level. Essentially, we're talking about 2 main types of asset classes, which is equities on the one hand and bonds on the other hand. So it's an inter-allocation between a choice of how much you want to allocate in equities versus bonds. So if you look at the different types of portfolios here, you'll probably see as a reference point that conservative portfolios may tend to suit investors who have a lower tolerance for risk. They may not be able to accept if markets, let's say, go down by 10, 20% or more, and they probably lose sleep over that. So they probably will gravitate towards the more conservative portfolios. But if you are an investor who cannot stand having 2 to 3% annualized returns, then perhaps the more aggressive portfolios would be a more suitable reference point for you. So here you also find that in a neutral market environment, we advocate the settings which are in the table below. But when we enter 2021, we also hold a view that we actually prefer equities over bonds. And therefore, we are adding 5 percentage points to the different asset allocations you can see. And that's reflected at the top part of this slide. The only exception is for the aggressive portfolio because no matter what market conditions, we always advocate that you have at least 10% in the bonds portion of the aggressive portfolios to act as a cushion for you. So on the previous slide, I spoke about inter-allocation between equities and bonds. Here, I'll go one level deeper, which is in the form of intra-asset allocation. So that's essentially within equities, what should you invest into? And likewise for bonds, within bonds, we ask ourselves, what should we invest into? So if I use the bonds portion as an example, for those of us who manage our money from a Singapore dollar perspective, we will have a relatively big portion in Singapore-centric bonds. Then for further diversification, we will have some global bonds, some Asian investment grade bonds, and high yield bonds, for example. So there's the neutral allocation, as you can see in the table, as well as the current stance. So the current stance reflects our view as we enter 2021. And we are overweight certain sectors, for example, emerging markets bonds and Asian high yield bonds, and either neutral or underweight the other types of bonds. For investors looking for yields, emerging markets and Asian high yield bonds continue to offer attractive spreads, we believe, at this point of time. Within equities, we have overweight in Asia ex-Japan, Latin America, and China. I think the one which stands out here perhaps for a number of you is the digital economy, where we have an underweight position. That's simply because of the huge run-up that we have seen in 2020, and valuations have really surged. And we believe that this sector has gotten a little bit expensive. So our research team is suggesting that we take some profits off the table, still keep it, but trim the position in digital economy and move into other more attractively asset classes, such as the financial sector. Here I want to bring up what we call the core and supplementary portfolio concept. Simply put, the core portfolio has the dominant markets and sectors which we expect will continue to be important in the future. So in the last 1 year or so, we actually introduced China and digital economy to be inserted in the core portion. And that's to reflect our view that these are going to be long-term important building blocks in any portfolio. But for many of us, including myself, I like to have tactical positions as well into something that can give me the extra potential boost in terms of returns. And of course, remember the pendulum that I was talking about, which can be boosted up, but can also be boosted on the way down. So from a risk-return perspective, we are suggesting that tactical ideas, while exciting, they should be kept to, let's say, roughly about 20% of your overall portfolio, and the remaining should be about 80% in the core portion. This point here is about market fundamentals and why it always matters. So in the shorter time period, when there is a lot of exuberance in a certain market or sector, the danger is that fundamentals may be forgotten. So when markets experience excesses, it is the quality companies with good fundamentals, be it in terms of earnings growth, business model, balance sheet strength, and so on, that will stay strong in the longer term. So looking at the Asia ex-Japan index, you can see the performance in blue here. The orange line is the earnings growth. First, you will see that there is a good correlation between earnings growth and the market performance. That makes a lot of sense. If a stock makes money, investors will reward that stock, right? So the same goes for an index, which is made up of many stocks. But a question we should also ask or think is what lies ahead for that market? That's where our analysts bring up the expected earnings growth forecast for this coming year, 2021, as well as next year, 2022. And we compare to the usual valuation of the market, and we see what's the potential upside lying ahead. In this case, for the Asia ex-Japan market, our research is pointing to roughly 18% return by 2022. If you're interested in such analysis, we have more information on our website and mobile app, and Colin, my colleague from the research team, will be sharing a lot more in his presentation later on. This tip is something that I've learned over the years. It's simply about having a regular savings plan, or RSP. And I think that's one key strategy that I would advocate to any of you. And I've implemented that quite dutifully or diligently throughout my 30s. So an RSP gives me a lot of discipline because it forces me to invest every month. I can change the amounts anytime. I can start or terminate an RSP anytime as well. And RSP allows us to benefit from the concept of dollar cost averaging. So when markets go down, if I invest $100 a month into a certain product, well, that gives me more units of that product. I will not be sitting on the sidelines trying to time my entry in the markets when the markets revert back to going up. So I'm essentially always fully invested. I would like to quote someone else here, the investment guru Benjamin Graham, who said, "The investor's chief problem and his worst enemy is likely to be himself." In the end, how your investments behave is much less important than how you behave. So I think an RSP removes all that emotional behavior and keeps us very grounded in terms of our strategy. And of course, an RSP works very well for more volatile markets and more volatile conditions as well. RSP as well allows us to enjoy the power of compounding. So personally, for all the funds that give dividends for myself in my portfolio, I'll choose the reinvestment option to enjoy the power of compounding. At FSMOne, we have a few tools, including the RSP calculator, which you can use. You can input your monthly RSP amount and any lump sum amount that you would like to invest, and you can choose a time frame, for example, 5 years, 10 years, 15 years, or 20 years. And what that will do is it will churn out a chart and a table for you in terms of how much that portfolio can possibly grow to. So if it's a time frame of 5 years, for example, and assuming you put 1K every month, and you have a lump sum investment amount of 10K, it can grow to close to 100K in roughly 5 years, assuming a 12% annual return. And when people say that let time work its magic, it's very, very true in the markets. So if you invest the same amounts that I mentioned just now, but over a longer time frame of 20 years, instead of 5 years, instead of 100K, the portfolio can grow to $1 million based on the same 12% return assumption. So now moving on to how I'm planning my own portfolio. This is something that I do based on my own life goals, and I have different life goals, which means different buckets. So for bucket number 1, it is relatively simple in terms of my objectives. Beat the savings account rates comfortably. That is definitely not hard to achieve actually. And this objective of mine applies for both my cash as well as my SRS money. So back to bucket number 1, I go for a number of funds. So I'll run through the first few here. So firstly, money market funds, for example, the Lion Global SGD Money Market Fund. Secondly, short duration bond funds like the Nikko AM Shenzhen Short-Term Bond Fund SGD. And thirdly, Singapore-centric bond funds like the Eastspring Singapore Select Bond. It's important to see that these funds display a certain amount of volatility, as you can see in the graph. So do make use of our tools, such as the chart center and the fund selector, to look into the volatility and as well the returns of the different funds. This second bucket is for my children. So I want to build up something for them in terms of investment amount that they can use in future for their future education, or something meaningful in terms of perhaps some future endeavors that they have in mind. And also, when they are old enough, because they're still very young at this point, I hope that they can appreciate the value in investing and do their own investing as well. So here I chose the FSM managed portfolios, and very specifically the moderately aggressive portfolio. The neutral inter-asset allocation is roughly 70% into equities and 30% into bonds. The portfolio has done pretty well since inception, which is about 4 years ago. It has returned roughly about 9.5% per year. The last 1 year, of course, in a certain bull market, right, has done especially well with a 17.4% return. I think the FSM managed portfolios are a good choice for those of us who want something more ready-made, and we want to leave the asset allocation to the portfolio management team, as well as the decision to rebalance the portfolio to the portfolio management team as well. So if I can go back to last year, I think one of the decisions that the team made which helped was the inclusion of the digital economy ETF, which we call OGIC, roughly around April of last year in the core portfolio in the equity portion. I mentioned about equities to bonds and why we prefer equities to bonds. So we have an extra 5 percentage points in equities. So going back to my moderately aggressive portfolio, so the equities add up to roughly 75% of the portfolio and bonds add up to 25%, as you can see on this slide. I also mentioned the concept of core versus supplementary. For this slide, what you can see is the free ETFs which are inside the supplementary portion of the portfolio. These consist of our favorite tactical ideas, which is digital economy, Chinese technology, and semiconductors. Please note that the information is as at 31st December of last year. So our portfolio management team is looking to make some tweaks for the supplementary portion. I think you kind of guess roughly what they're going to do. They're going to take some profits off from digital economy and especially the Chinese tech ETF and introduce the financial sector, which is a beneficiary of the broader global economic recovery that we're seeing, and the expected earnings growth revisions that we will expect to see as well, and a fall in loan loss provisions, which a number of my analysts have alluded to in previous presentations. So here, for the third bucket for my retirement, I'll be sharing a bit more about how my portfolio looks like in terms of my retirement goals. And it's essentially in funds and ETFs across both cash and SRS payment modes. So I invest based on a long time horizon of roughly 15 years to 20 years. I also like to have a mixture of lump sums and RSPs. So this is where my position stands at the start of this year, 2021. So it's something personal. It doesn't apply to everyone. As you can tell by now, I have a bias towards Asia. So besides my core Asia fund, you can also see from this table, from this slide, right, that I also have a position in Asian small caps. And with the recovery that we expect in Asia, I thought it will make sense to look into some of the smaller companies in Asia. So here I went for the PineBridge fund, for example. I also have an exposure to Asian REITs, which have seen a very K-shaped recovery because the outlook is very different for the different REIT segments. So I have an ETF here that is invested in Asian REITs, and there's a lot of representation from SGX listed ETFs, but you also find some exposure from Hong Kong listed REITs as well. I use the term digital economy very broadly to include disruptive innovation and related themes. So in my portfolio here, I have the Nikko AM Disruptive Innovation Fund, as well as the Lion Global Disruptive Innovation Funds, which I invested using my cash and SRS respectively. I also have an RSP in those funds. After the run-up in these two funds last year, I'm staying invested. I'm prepared for the increased volatility in those sectors, which will happen because no investment, as I have said, will keep going up in a one straight line because those investments have done really well last year. I'll stick to my RSP strategy, which actually works even better with funds when markets are more volatile. But I'm adding to a new position in financials. I went for a global financials fund as well as one that is more focused on fintech. So essentially that captures my portfolio positioning at the start of this year. And with that, I thank you very much for your attention. I just wanted to end up with a few words. Investing, I think it's a journey that continues to teach me new things, even for myself. And I hope that no matter what the markets throw to us, be it good or bad experiences, we'll always take it as something that we can learn from and we can invest better and more profitably. So have a very happy, healthy and hot year. Thank you very much.
Thank you, Jean-Paul Wong. Investing can seem confusing and treacherous, like a jungle. To survive first and thrive later, we need a survival kit. In the same way as one would take great care in preparing and packing their bags for an adventure, new investors stepping out into their investing journeys need to be equally prepared and armed with the right knowledge. Let us hear from Timothy Ho, Managing Editor and co-founder of Dollars and Cents, as he shares what he believes are the most important things investors need to know in order to invest successfully.
All right, thank you, FSM. When FSMOne told me that I was going to be presenting and they want to talk about how to survive in the jungle of investing, I was excited, and the reason is because I'm a big Survivor fan. So I know a lot about surviving because I watched Survivor since I was a kid. So today I decided, why not bring a little bit of the concept of Survivor, how people play survival, into the world of investing, and let's see, what can we learn from Survivor. So, the host for Survivor, Jeff Probst, he always say, outwit, outplay, outlast your opponents, right? So how can we apply this concept to investing? And let's look at the first thing first, outwit. Okay, so who exactly are we trying to outwit here? Yes, it's a Survivor term, but we're not exactly trying to, I'm not trying to outwit John Paul, I'm not trying to outwit you guys at home. We're trying to outwit the market, right? We're trying to outwit the market. And one of the biggest problem with outwitting the market, it's very simple. It's us. We are the problems. And let me just give you an illustration. So if you are, on a boat and you are stranded or your boat sinks, you're going to find yourself in the sea, right? And one of the worst thing that can happen for you in the sea is drowning. Obviously, it's a real problem, not just in Survivor, but in real life. And I once went for a lifeguard course when I was in NS. So I went for a lifeguard course. And the instructor, the first thing he told us, one of the things that I remember him telling us, and this is with context to trying to save somebody, is that, when you're trying to save somebody and you're swimming towards the person and the person is pinning you down because the person is struggling, the person is panicking, what's the one thing you should do? It's not to panic, not to fight him, not to overpower him, but to sink yourself. So that's the tip, the first and most important tip. So if you don't remember anything today and one day, you're trying to save somebody, but the person is in the swimming pool, but the person is struggling and all those things and you can't get out, just sink, just drown yourself. That's the first thing to do, because when you drown yourself, the person will immediately let go of you. You don't panic and you don't try to fight him, because panicking, trying to overpower the person, whether it's you or someone else, it's just going to waste your energy. It's just going to put you in a worse position than you already is. And let's be clear, drowning, losing money in the stock market is already a bad position. So the similarity is there, right, between drowning and losing money in the stock market. Our instincts are telling us to do one thing, but that's not the correct thing we should be doing. So for example, in the stock market, for those of you, if you guys have been investing in 2020 or even before that, one of the first things that would have scared you in March 2020 is, why my portfolio is red suddenly? It's been green for so many years. Suddenly, the gains that I've made over the last 3 years all go into red. And one of the things you might do is instinctively you might try to sell. You would try to sell because you want to cut your losses. Secondly, you might want to stop investing. Let's not invest anymore because every week we put in money, it goes even lower the next week, right? We might do that. Or, for some of us, we might even try to do something silly like borrow money to invest. So all these are bad responses to an already sucky position. So similar to swimming, when you find yourself panicking, you're drowning, don't panic even though it's the natural instinct. What should you do instead? Here's the thing, very simple, right? Acknowledge the bad situation you are already in. Nobody wants to be stuck in a pool, when and they are looking to survive, And one of the things that we realize also is that I think John was saying he started his investing journey at 2003, right? So John would have been through at least I think 4 major recessions: 2003 SARS crisis, 2008 GFC, 2011 Europe debt crisis, 2015 China market rout, and then of course COVID-19. So that's 5 recessions in 18 years. If it's a bit older, he would have experienced the 2000 dot-com crisis as well. So the first thing to know is that when you're already investing in the long term, you will actually be able to. Sorry, I need the slides to be bigger. I can't see my slides. All right. Okay, so when you're investing in the long term, you would eventually encounter multiple recessions. And I think the first thing to remember is that if you lose money in the stock market last year, it's not your fault, all right? A lot of people think at March 2020 when they lost money that it's their fault. They must have invested wrongly. They chose the wrong companies. They should have gone digital. Why were we investing in banks? That was a bad idea. That's not true. It's not your fault that you lose money in March 2020 last year, okay? The second thing you need to know is that you already lost money and panicking is not going to help. I always say this, whether it's drowning or losing money, people always make bad decisions when they feel like, when they're emotional or when they need to make a decision. So for example, if you are hungry, you overeat. If you are stressed, you drink too much. If you gamble and you lose money, you borrow. People always make emotional decision when they're stressed, and panicking is an emotional decision because you lose money, you're worried, you want to do something, but that's not a good idea, all right? And the third point, which is important, and this is something that's important not just about investing, but also in terms of actually anything in life, is that what you do next will determine the outcome, right? So if you think about it, if you are losing money and you already lost money, but what you do next will actually determine your outcome. Let me give you an example, right? Okay, so here's an illustration of how the S&P 500, the best and the worst days in the S&P 500 for the past 20 years. And you can see in green, I don't know if you guys can see, but you can see in green the 25 best days, and you can see in red the 25 worst days in the S&P 500 over the past 20 years. And one thing you would realize is that the reds and the greens are very close by together. What does that mean, right? And if you can see, it's typically in the year 2007, 2008, the GFC, the 2008-2009 GFC. And all the best days and the worst days of the past 20 years of the S&P 500 was all very close by in that same period of time. So what does that mean? Good days and bad days, they come very close together. And what happens when you encounter, like what we encountered last year, March 2020, we lose money, we exit from the market. This is what happens. And this is what happens if you miss the best 25 days in the market. Your returns, if you, let's say you sell after a bad loss of money, would be no different from treasury bills. You may as well put your money with government securities in the banks. And basically the point here is that not staying invested after you lost money, kind of like one of the worst things you can do, unfortunately, even though it sometimes is the instinctive thing to do. So next point, outlast. Okay, and with outlast, it's a very important point because the question we really ask ourselves is, how long can we survive? So I asked my wife this question just a few days ago. So I asked her, let's say we are on a boat, or let's say you are on a boat, and you know for a fact that your boat will sink and you'll be stranded on an island but you would survive and somebody would rescue you, right? So that's great, right? Because you know in advance that your boat is going to sink, you know that you will be stranded on an island, and you know somebody is going to rescue you. So that's great, right? So my question to her is, what will you pack? So what will you pack if it was you? What would you pack in your bag? And I'll give you guys like a few seconds to think about it. So what will you pack if you know for sure you're going to be stranded on an island, but someone will rescue you? Okay, so my wife responded to this with a quite good question. She said, how long will I be stranded? Then I say, I don't know. Why do you need to know how long you'll be stranded? And she said, oh, simple, right? Because how long I'm stranded will determine what I pack. If I'm going to be there for like 1 day, 2 days, then I just bring some, combat rations, maybe a few bottles of mineral water, and that would be enough because it's just 1-2 days. I'll be rescued, and that's it, right? I don't need anything else. But if I'm going to be stranded for a year, let's say, combat rations, mineral water, that's not going to be ideal, right? You need to have things that can let you survive in the jungle. So that would include, knives, fire, fishing rods, things like that, the stuff that they like to give on Survivor. And here's the problem, right? Here's the problem when it comes to stock investing during a recession. How long would the recession last? We don't know for sure, right? Sometimes we think that it's going to be a year, 2 years. People were saying that during March 2020, they were saying that, guys, let's not rush to invest. The pandemic's going to be here for another 1 year, 2 years. What's the reason of why do you want to invest? Just wait, Some people think of that, Some people would, FOMO a little bit. They think that market has crashed. It's time to go all in, But here's the question, right? Timing the market, timing the recession is generally a bad idea because what you're trying to do is you're trying to capture the bottom. You're trying to capture when the end, how bad can it be? And similar to being in the jungle, even if you know that you will be eventually rescued, you still don't know exactly when you'll be rescued, right? So you have to plan for the fact that you could be here 1 or 2 days and that will be great, or you could be here for 6 months, a year, 2 years. And if that's the case, how would your strategy change? And the truth is we don't know the answer, right? And I like to use this example. This is the STI. Last year's, according to, I think, CNBC or the Straits Times, one of the worst performing index in Asia, right? So I thought, why not take one of the worst performing index in Asia and see how it actually did in 2020, right? So this is a shot of how the STI performed. Not that good, you can see, I'm not excited. Those of you who invest in the STI, you guys are not so happy as well, right? Because you can clearly see the stock market crash. It went from about 3,002 to about 2,400 points. It went up, but not that great, still below where it used to be. So if you have invested a lump sum amount at the start of January, so you make a New Year resolution in January 2020, let me invest $10,000, you would have lost about 12% for January for the rest of the year, right? And this is in contrast to the S&P 500, which is up about 10 to 12%, right? So you would have lost money if you invested at the start of January 2020. But here's the thing, right? If you didn't want to time the market, if instead of deciding that you would invest everything in January, you try not to time the market, you do a dollar cost averaging. Every month you invest about $800, and for the rest of the year, you invest about $10,000 in total. Here's the thing. Even if you invest in the STI, which everyone says is the worst performing index in Asia last year, you would have still made money. Amazing, right? You invested in the worst index, according to people in Asia for 2020, and you would have still made about a 6% gain. You would have made early losses. So January, February, you would have paid high prices, and then March it slumped down. But if you just dollar cost average, it would have played out still pretty well. So my point here is this. In a recession, you don't want to time it. I know a lot of people back home, you guys are watching, you guys are probably saying, no, you have to time. Markets are going to go up. If I don't time, if I don't invest, I'm going to lose it out on it. But here's the truth, right? It's a recession, anything can happen, and you don't want to be caught out, in an area where you're not prepared for. And on this point, I think it's important to say, right, I still remember this very, very clearly back in, I think, circuit breaker time, May, June period. Everybody, you guys would know, right? Everybody around you was trying to say when would the pandemic end. Everybody has an opinion. Some people say at the end of the year. Some people say next year. Some people say, it's going to take 2-3 years before a vaccine comes, and that's going to be a long time. So everybody has an opinion about the thing. But let's just be honest, who actually knew? Nobody knew, right? Because it's a developing situation, right? And that's the point about timing the market it's the same thing with timing the market. Everybody has an opinion. Everyone thinks that they are right. Everyone has their own reasons why they are right, but nobody truly has the answer. And my last point would be outplay. So how do you outplay the market? How do you outplay and perform well, not just in survival, but in the investment space? And I think my point here is always stick to strong teams. A lot of people like to, when things are going well, it's always very easy to say this guy is doing better. This is a great company to work for. This person is a smart investment guru, right? But one thing you realize is that if you stick to strong teams, whether you are playing survivor or playing football or investing, you would always do well, not just in good times, but in bad times as well. I think that's the point. You want to be in a strong team. You want to choose companies that are going to do well in good times, but most importantly, you want to choose companies that are going to do well even during bad times. And you shouldn't deviate from that strategy, because at the end of the day, a strong team would beat a lesser capable team. And in this context, what would I think it looks like a strong team to me? I have 4 pointers. This is my personal view, so please, it's just my opinion. Don't make your investment based on just these decisions or these talks. The first is highly rated bonds, government bonds, highly rated AAA corporate bonds. The second, index-based ETFs. Third, gold, cash, and fourth, cash, most notably in Singapore dollars. Okay, here are government bonds. I think I need the slides a bit bigger. So these are government and corporate bonds performance last year, and I think one of the things that you would see is that on the left you have the Nikko AM SGD corporate bond ETF, and on the right you have the Temasek bonds. One of the things you would realize about the bonds is that during the worst stock market crash in recent history, both these bonds dropped by less than 3%, right? So these bonds dropped by less than 3% when the S&P 500 and the STI actually went down by 30% or more. And since then, they also have recovered. They have done well for 2020. They make a gain of around 6%, 5 to 6% for the year 2020. So you can see, that government and corporate bonds are a very good instruments to have when you actually are in a bad situation, right? And a lot of people, I saw the survey at the start, so you guys, I was keeping tab and I saw that, about 1% of you guys actually said that you all will invest in government bonds. And I think 3% said that you guys will invest in Bitcoin, cryptocurrency. So, cryptocurrency, is getting a lot more love than, say, bonds. So I know what you guys are thinking. Returns are low, why should I invest in government bonds? But that's exactly the point. When times are not good, you wish you have government bonds, as you can see, right? Even if you compare across the same, company, so and this company, you on the left you have Fraser Property, and on the right you see Capital Mall, and I use these two examples not because I love the companies or anything, but because they have bonds that are listed on the exchange. So you compare the stock prices and the bond prices, right? So Fraser Property dropped about 37% from between 24th Feb to 23rd March, 37%. The bonds dropped by about 10%, so that's not great either. But since then, and you look at the recovery, the bonds have already recovered. So they are up about 11% since then. They are trading at more than $1, while the stock has not recovered since then. And the same thing with Capital Mall. stocks, Capital Mall share price dropped by about 35% within a period of 1 month. 35% is a lot of money. The same company that issued the bonds, the bonds only dropped by about 3%. And since then, the bonds are also trading at a premium above $1 now. So you can clearly see that bonds, even for the same company that have equity and bonds, the bonds are very defensive in nature. And in a recession setting, that's how it's going to help you protect your portfolio. Next will be index-based ETF. And there are a lot of ETFs that I could have used, but I decided to use a Hong Kong, the Hang Seng Tech Index. And here's the reason why I'm using it. And you can see the Hang Seng Tech Index did very well in 2020 as well. But the reason why I'm showing this is because, I think it's pretty much an open secret that technology stocks have done very well in 2020. But let me just give you guys an example between two very similar companies, Xiaomi and Lenovo Group, right? So both are tech companies, both are hardware companies, and if you didn't see this screen before that, you would have expected both of them to do well in 2020 because technology companies were doing well, and that's true for Xiaomi, right? So at the start of the year, Xiaomi was trading at around $10, $11, $12, and it ended the year at about close to, I think, $30, $29, $30, at the end of the year. So, that's, an increase of about 2 to 3 times in 1 year, and that makes sense. But the interesting thing is, you look at Lenovo Group, right? And Lenovo is also in the same ETF, and it actually went down in the whole of from January to November. It actually went down from about $6 at the start of the year to about, $5 something as of 30th December. So with regards to that, you can see even for the same company, let's say you had a presumption, you knew that tech stocks were going to do well in 2020, right? Let's say you already had the benefit of hindsight, you knew that tech stocks were going to do well in 2020, but you choose the wrong company for whatever reason, right? You choose a company over the other, you might still be losing money even though its peers are all making money. And that's exactly why it is important, even if you know for sure that tech stocks are going to do well, that you want a diversified pool. You want an index-based ETF. The third is gold. And gold is not getting much love recently. I know what people are saying because its prices have not increased since December, and people are saying, hey, gold, it's not moving, every other asset classes are moving, why should I invest in gold? But here's the fact, right? If you look at from Jan all the way to December, gold did really well as an asset class. It went from about 1,000, below 1,006, about 1,005 at the start of the year, all the way close to about 1,008, 1,009 by the end of the year. Since then, it has not increased, but it is still stabilizing, and that's exactly why people don't like it, because the asset prices are not going up. But it's still something that you would wish you have when you have a recession portfolio. And lastly, is really the Sing dollar. And I think I was having a chat with some of the guys just now, and a lot of people are hesitant to keep on to money right now because they feel like interest rates are low, high liquidity, asset prices are going up. If I hold my money, how it's going to depreciate in value. The value is just going to go down. But I think that's not really true, because at the end of the day, when it comes to investing, when it comes to going into a recession, you need to have the ammo. You need to have the ammo to be able to deploy when a recession comes, and that's something that we cannot forget. Even though right now, there's a bull market and people are just trying to rush in to invest. And I will leave you with these final words, which is simply, in a recession, in a survival setting, you need to thrive, but before you thrive, you need to survive first. And without surviving, if you're not able to survive the recession, you will not be putting yourself in a position to thrive. So hopefully this has been useful. I think 2021 is going to be a challenging year for the investment space. There's a lot of assets, in my opinion, expectations has gone ahead of earnings. So you got to be careful. You got to continue to invest. Remember the dollar cost averaging concept. You got to continue to invest but you still need to make sure that you protect your portfolio well. Thank you.
Thank you, Timothy. Before we move on to the next presentation, do check out the unit trust promotion that FSMOne.com is currently running. Receive $10 bonus units for every $10,000 invested in any of the 21 unit trusts from our top 5 markets and 4 mega themes. Which are these 21 funds? Head over to FSMOne.com to find out. This promotion lasts until the 31st of January 2021. You can also, for a 6-month period from 8th of February 2021 to 31st of July 2021, enjoy a 0% processing fee when you transact via a regular savings plan. There's no better time to get started with ETF RSP. Open an FSMOne.com account in just 5 minutes today via MyInfo. From the 9th of January to the 26th of January, open a new FSMOne account to receive 3,000 rewards points. To enjoy this promotion, you must click on the Promotions tab on the black menu bar and complete the form via the Account Opening Promotion form. Then click on the Submit and Proceed to Account Opening button to get to the FSM Account Opening page. If you know of somebody who does not have an FSMOne.com account, now is the best time to get them to start one. Refer a friend to open an FSMOne account from today till the 26th of January, and you will stand to receive 3,000 rewards points for each friend, up to a maximum of 15,000 rewards points. Do note that if your FSMOne account was opened directly on our main website without submitting the form below, you will not be eligible for this promotion. Also, if you have any questions regarding the presentations today, leave them in the Q&A section by clicking on the Ask Question button, and we'll have our speakers take these questions later on today. Up next, we have Dawn, also known as Budget Babe. Hear from her and pick up ideas about how you too can start investing in a disciplined and profitable manner. She will share how she puts together her investment portfolio as a young adult and her considerations that went into each decision.
Hi everyone, my name is Dawn and I write at sgbudgetbabe.com. Now today, we're going to talk a little bit more about starting your very first portfolio when you're investors. I understand it can feel really daunting when you first start out because there's so much information, so much tools, so much options. Trust me, I've been there before. So I'm going to be guiding you through how I overcame that and how you can do so for yourself. But before we start, usual disclaimer. Okay, let's get that out of the way. Now, I've helped to frame this into 5 key questions. So your answers to these 5 questions can help you to determine which is the best method to take when it comes to constructing your first investment portfolio. The very first criteria, capital. Now, how much capital you have to begin with is important. Because if you're starting small with just, let's say, $50 or $100 a month, the options available to you are going to be very different from those available to someone with $1,000 a month. And many investors who do monthly injections, they basically go for this method called dollar cost averaging, aka DCA. And depending on the amount that you have each month, you could choose to go for a regular share saving plan, buy into a fund, an index, or even individual stocks or bonds. And what if you're starting out with an even bigger lump sum? Then in that case, you may want to be approaching your portfolio from an end goal perspective instead of starting with baby steps. So for example, if you have $20,000 to begin with, maybe you want to split that into 10 positions of $4,000 each. Or, if you have $100,000, then maybe you might want to do the same and increase your position on each, or have more positions, or even less if you're more concentrated. Now, there's no magic formula, there's no magic number, so $10 or $4,000 per stock is not a recommendation. It's not going to be a rule that you have to follow. There are many permutations and ways that you can do it. Okay, the second thing you need to know is after you know how much you have to work with, you need to know why are you investing and what are you investing for. Now, there are some people who invest for shorter term goals, such as to make money to fund their travel lasts around the world. Others could be parents investing for their kids' future education fees, which usually are about 10 to 20 years. So one-hit wonders are just not going to cut it. Maybe for you, you might be saving towards financial freedom or even retirement. And then this will help you to determine your time horizon in the market, which then knows which portfolio and which type of options would be more suitable for you in that time frame. Now, there are some people whose goals are simply just to beat inflation. I have a friend like this, and all he does is invest in his index funds, and he spends the majority of his time on his work and hobbies and families. But there are others out there who want to earn passive income, so they tend to prefer stocks that pay out dividends, and the higher the better. There are also other people. I have a friend who has really, really aggressive goals, and he said, I want to double and triple my money within X period of time. Now, you look at your goals that will help you to know what investments to take. Of course, for many beginner investors, you want to know what the most common mistake that they make? Being too emotional. I was there before, and I've seen a lot of beginners, you see these online, they say things like, yay, I've earned $20 last night, or oh no, the stock dropped by 3%. I have a friend who cuts loss every time his stock falls by more than 3%. So when I told him that my stock can fluctuate between 5 to 7% easily within a few days, he was horrified. He was like, what? So, you need to understand how you react to changing stock prices. It's super easy and very natural for humans that when stock markets go up, we feel good. When stock markets go down, we start to get scared, and we maybe even sell out. But the truth is, if you invest with your heart and emotions, you're going to be setting yourself up for failure. I'll give you a few personal examples. In 2016, and last year's March crash, that was when I found some of my biggest winners. Because when the oil crisis happened, that was when I picked up DBS. Many people feared the banks because they had huge exposure to oil debts on their books. But when I look at the numbers and I did some calculations, I just felt that DBS was oversold. So I went in, it's now doubled. Similarly, if you remember how the whole world was freaking out in March last year when the markets crashed, one of the stocks I bought then was Disney. Because many people are avoiding it due to its theme parks business, where the global restrictions on travel were hitting them badly. But don't forget, Disney has other businesses as well. So when I did a sum of the parts calculation and I analyzed it, I again felt that it was oversold, so I bought it. Less than a year, it's already doubled. In fact, I don't even understand why it doubled so fast, because I thought it would take a little longer for it to recover back to normal. But there it is, it's a stock market, and it's really, really great that I managed to get that bargains because I did not panic when everyone else was. So your risk levels will then determine how you react to all of these changing stock prices. Because if you have a low risk appetite, then you might want to avoid more volatile instruments. Here's a good flow chart that you can take a picture of to determine where exactly is your risk level. So if you can also relate to these statements on this next slide, then you probably have a lower risk appetite. So maybe avoid instruments that are extremely volatile, or even you might want to be investing with professional fund managers to handle your money instead. So look at yourself, look internally, understand where you are, and then you'll find what works best for you. Now, the next criteria is time. Because you need time to study the business, the stocks or the investment, monitor them, as well as to basically buy and sell. So if you are someone who works multiple jobs, have young children at home demanding your attention, then you may not have a lot of time to work in the markets and to study it. Then you'll be working with a lot less information than someone who spends several hours a day on the markets and his investments. So in this case, you want to know how much time can you spare on your investment and your market, and then you know what options will better fit you. So there's some people, or some friends of mine, they basically spend hours on the markets every single day and they trade very frequently. But I also have other friends who barely even have 5 minutes a day. So they go for investments that don't really need that monitoring. They only can just check in maybe every few weeks or every few months. There's different investments out there. It's a huge world, many options. You'll pick the one that works best for you. Alright? Now, the fifth question, and the most important one, because now that you understood yourself a lot better from the last 4, you now know which strategy and which method to use to implement. Should you do it yourself? Well, if you have the time, energy, and knowledge, then why not? But if you're totally clueless, you still want to invest, there's also guided options such as robo-advisors or regular share saving plan, or even managed portfolios that you can choose from, right? So if you look at all of these different strategy statements here, which one do you find yourself relating the most to? The first one here tend to usually describe DIY investors or traders. The second group goes for robo-advisors many times. And the third group would tend to usually go for products such as unit trusts or robo-advisors, and maybe those with a bit more capital may choose to put their money in hedge funds instead. Now, as beginners, a really popular tool that's emerging in recent years are robo-advisors. It's not surprising, right? Because they have low fees, low capital requirement, and they even give you pre-selected portfolios. Super easy for beginners to start with. All you need to do is answer a few questions. Then they recommend the best fit portfolio to you and you're all set to go. So, but if you look at those options that they recommend and you don't like it, maybe you want a bit more control like me, right? And maybe what about individual shares? You could, for example, buy maybe 5 shares to start off with for your portfolio. Let's use these 5 digital giants as an example, since most of you would probably be already familiar with them. But if you do the math, you'll find that you need at least $5,000 to $6,000 just to own 1 share of each. But what if you have only, let's say, $2,000 to start with? And we haven't even added in the brokerage fees for these transactions. So in this case, then maybe you can do something what we call an exchange traded fund, ETF. So this basically refers to a fund that has a basket of stocks, alright? And if you look at these 5 digital giants, there are a few ETFs there that do contain exposure to these 5, such as the First Trust Dow Jones Index, Internet Index Fund, right? They have all of these 5 companies we looked at and more. And at over $200 right now, your $2,000 can get you about 9 shares, inclusive of brokerage fees. There are some investors who basically construct their entire portfolio only based on ETFs. One way that you could do this, for example, would be to look at what you think the future could look like and go for thematic ETFs that fit your vision of that. So for example, if you want to ride on the growing financial market in China, there's an ETF for that. If you want to ride on the largest 500 companies in the US, there's also the S&P 500 for that. There are even ETFs for gold, pharmaceutical, education, clean energy, and the last I heard, even space is going to have its own ETF soon. So you can see lots of stuff and options out there. I tend to use the FSMOne ETF focus list page to start my research from. You could also do that if you want. Now, and of course, since FSMOne has basically invited me here, I can also use their managed portfolios to illustrate. Because if you had said yes to having to just choose from the portfolio you wanted, you said, right, you want people to suggest the portfolio to you, then you just choose. Okay, so in this case, remember question 2 on your goals. So FSMOne online, you can basically answer, do you want income or growth? And then look at your risk appetite. How much risk can you stomach? So when I toggle my option for that, for instance, they suggested the moderately aggressive growth portfolio for me, with more weight on global equities and lesser on bonds. Now, these portfolio suggestions are basically constructed for you based on your input, so all you need to do is pick them. And if you don't like the option, then just toggle a little bit again, see what comes up. Pick the one you want, and then inject your capital investments. So now that you understand how it works, let me show you how I use this exact framework to guide my thinking and portfolio when I first started as an investor several years ago. Now, I started out with $20,000 in cash. And because I was only in my 20s back then, I wanted capital gains because I felt I was young and I would have time on my side. I plan to switch it to dividends much later on, probably closer to my retirement years. And you've really probably seen from my last few minutes talking that I can generally stomach a little bit of risk. I'm not super emotional when it comes to the stock markets and when prices move up or down. So that's why I generally don't get phased if, let's say, there's a 5% or 7% movement daily. Only if it's maybe 10% or more, double digit, then I might take a closer look and maybe take some action. So because of this preference to want to be in control, and because I enjoy studying businesses, I like to know what they do, how do they do it, how do they make the profits that they do, and what are their plans for the future to grow them. So when I look at all of this, okay, I actually need time. So I set aside time for my investments, and that's why I personally chose to go for a DIY approach. And you can see, here's a rough overview of my portfolio now. You can realize, okay, if you look back at the 5 questions, my answers to it basically explains why my portfolio looks like this. And because my risk appetite is a bit higher, I even have up to 10% of my portfolio in alternative assets such as Bitcoin and cryptocurrency. Actually, it's less, but it went up a lot now, so it's about 10% now. And I also have a safe component in my portfolio, such as DBS, REITs, domestic-backed bonds. But my biggest conviction of the future is on growth companies. And you can see, my portfolio basically reflects that conviction as well. So the next question then I face is markets. Because should I be investing in Singapore stocks only or looking at US, global stocks? What market should I be looking at? Now, when I first started, I felt that I was still new, so I wanted a bit more home ground advantage, brands and businesses that I can really go down and look at and study. So I first started with SGX. Later on, once I got a bit more comfortable, I moved on to the US markets and then even into the cryptocurrency markets. And after a trip to China opened my eyes up to the opportunity there, I started investing in the Hong Kong markets as well. So this is my personal investment journey from a beginner all the way until now. I'm still learning. I'm sure all of us speakers here still are. And the day you stop learning, that's when we stop growing. So we're never going to stop learning. And I hope that you also be the same. So I hope that you guys found this useful. Remember the 5-step framework, and I hope you now have a much clearer idea on how you can construct your own portfolio. It's not that difficult, and don't be scared by the unknown. I've helped to make it into 5 simple questions, so now the unknown is known, and you can go ahead to create your own. Alright? Now, if you enjoyed this and you'd like to learn more, join 30 million others who have been following my blog to learn about personal finance and investing. And over on Instagram and YouTube, I also do investment guides, so do follow and subscribe. I'll see you guys online, and remember, all the best in starting your own personal beginner investment journey.
Thank you, Don. After understanding the essentials needed to start investing and the insight into deciding on your first portfolio, we need to know where to focus our investments on. In our next segment, hear from Colin Low, Senior Macro Analyst at IFA Singapore, who will share what we expect to happen in the major economies around the world in 2021 and some interesting opportunities arising in the wake of the pandemic.
Hi, good evening, everybody. I'm Colin, the Senior Analyst from Macro Research Team. So today I'll be bringing you guys through the macro outlook of this year, and more importantly, where to get started with investing this year. So first, let's have a shot at looking at the macro outlook. So I believe that it's important for investors to first understand where we are in the global economic cycle, and because knowing where we are helps us with the asset allocation decision. Right here, we believe the worst is over and we have passed the trough, and we're at the early phase of the economic expansion cycle. And with that, we'll be entering a global cycle recovery. And on this slide, you can see another illustration of the global cycle recovery and how it impacts growth in general. So as denoted by the green lines in this chart, you'll find that the cycle recovery itself, especially in the early cycle, tends to be very robust. And if I were to direct your attention to the right-hand side of the chart, you'll find that hey, as we come out of this trough, we are expecting very strong global recovery in this year as well as the next year. So in fact, overall, we are looking at above consensus global GDP growth of 5.8% this year and about 4% the next year. But as a whole, our growth outlook for the year remains very constructive. And we believe a major theme this year will be a vaccine-led cycle recovery. And if you look at the different segments of this chart right here, you'll find that Asia, particularly China itself, should lead global growth in this year. So another thing that we are looking out for is the expectation of a robust global profit recovery, and one that is led by cyclical markets. So if you have to direct your attention to the left-hand side of the chart, you'll find that most of these cyclical markets, in fact, are actually emerging markets. And that reflects our optimism on the emerging market as a whole. And also another thing to note here is that since March low, most of the recovery itself were driven by valuation expansion. And in fact, looking ahead, moving into more of a long-term growth phase, we believe a strong EPS recovery should drive equity returns this year for a lot of markets. So moving on to the risk backdrop itself, we were to look at the risk for last year, we will find that some of the key risks that investors focus on is COVID-19 uncertainties, US-China trade tension, deflation, as well as US election. But if you look at this year itself, many of these key risks and headwinds have subsided. So firstly, we look at the COVID-19 uncertainty. We believe that it has reduced, and that is largely because of the progress in the vaccine development as well as economic and earnings recovery. Also, we believe the US-China tension have subsided as well, and that is largely in part due to the Biden administration. And for certain event risks such as US election itself, these key risks have in fact subsided quite tremendously over the past couple of months. And carry on into this year, we are seeing almost no overhang from the US general election. And lastly, for the risk itself, for deflation risk, we see it morphing into minor inflation worries. While I put it as a minor inflation worries because we think that the risk of severe inflation right now is still immaterial. But with that said, it's something that we are looking out for in the near term.
But overall, with what I said, 4 key factors shape our asset allocation decision this year. And these 4 key reasons are A, robust EPS recovery this year, and B, a supportive macro and policy backdrop, and C, a stronger expected returns for equity, especially over fixed income, and D, a milder risk backdrop in 2021. So overall, this decision forms our preference for pro-risk as well as pro-cycle exposure. And broadly speaking, we will recommend investors to hold a modest overweight for equities over fixed income. So once now that we have tackled the outlook for global macro, let us move on to the outlook for equities. So having established our preference for pro-risk as well as pro-cycle, we believe that EM as well and Asia ex-Japan equities best express this view. And overall, as a whole, the outlook for EM and AXJ equities are in fact very favorable, and we do expect strong performance in this year. So as can be seen from the slide here, I think it clearly states in the headline that we believe that 2021 will be the year of emerging markets. So a key reason driving this is because of the combination of catalysts that we will be seeing for EMs this year. And then last we saw this combination of catalysts more than 10 years ago after the GFC. So these catalysts are shown on the slides here. So firstly, it is the robust economic recovery. Second is the prolonged US dollar weakness. Thirdly is the cyclical EPS recovery. And lastly is the commodities upcycle. And these 4 key catalysts underpins our favorable view on emerging markets. And overall, as a whole, we are looking at 70% upside over the next 2 years. So over the next couple of slides, I'll be going through in detail some of these key catalysts. So beginning with the first one, we believe that EM equities are ripe for a strong cycle-driven EPS recovery. So if you take a closer look at this chart right here, you'll find that the EPS recovery tends to be very strong coming out of a recession. So it ranges between 30 to 60%. And the key reason for that is because EM equities has a huge cycle exposure of about 60 to 70% of the whole index. So with that said, we expect the same for this year as well as the next year, because we see this concentration of cycle exposure driving this EPS recovery for emerging markets. So the other big tailwind for EM equities, in fact, is dollar weakness. So as shown from this chart right here, which plots the US dollar versus the MSCI Emerging Market Index, in fact, you'll find a very tight and strong negative correlationship between US dollar strength and EM equity performance. So what this simply means is that whenever US dollar weakens, we see EM equity performance getting stronger and stronger. So in fact, we hold a view that the US dollar itself is going to be in a multi-year bear market. So with that said, that translates to multi-year support for EM equities. So while this is quite a strong statement to be made, and certainly I might be wrong, but if you take a look at this strong correlation, I think it lends a strong credence to our argument and our belief that a dollar weakness should support EM markets moving ahead. And the next big tailwind for EM equities is a commodity upcycle. So a commodity upcycle, we expect it should kick in somewhere around this year, and 2 key reasons should underpin this upcycle. So number one, we are looking at possible supply-demand mismatch for most of the commodity complexes. And number 2, commodity prices will be driven by dollar weakness. But overall, if you can see from the chart right here, which shows the MSCI EM earnings growth versus the commodity price growth, you'll find that rising commodity prices boost profitability for EM corporates. And in fact, whenever commodity prices rises, it tends to lead EM forward earnings growth by about 3 months. So with that said, let me move on to the next key region that we favor, which is Asia ex-Japan. So broadly speaking, we see AXJ equities offering the best risk reward amongst EM equities. So technically, AXJ equities can't be considered as EM equities, but a large part of the AXJ equities actually falls in the universe of the EM equities. And in fact, because of this, they experience some of the key tailwinds that EM equities actually faces. And those tailwinds are like some of those that I've just described, like dollar weakness, and as well as a cyclical EPS recovery. But on top of that, we see 3 integral reasons that underpins our favorable view on AXJ equities. And number 1, this is a better economic and earnings fundamental. Number 2, global manufacturing and tech cycle recovery. And thirdly is a reduced US-China geopolitical risk. So in this slide, I would just like to go in a little bit more into detail on the AXJ equities, especially on the fundamental portion. So we believe that ASJ equities are showing improving fundamentals, both on the economy side as well as the corporate earnings sides. And in fact, these fundamentals have proven to be better relative to other regions. So on the chart on the left-hand side, denoted by the blue line, you can clearly see that export itself has since rebounded tremendously from March low. And in fact, if you were to overlay the Nomura Asia Export Leading Index itself, you'll find that, hey, we are expecting Asia exports growth to improve over next quarter. And this is aligning itself with our own forecast as well as some of the data out there. So data pertaining to the PMIs, manufacturing PMIs, in fact, as well as the industrial growth. So this is an important point because exports itself is a major driver for many of the Asian growth. And with the expectation for exports to improve, we do expect that to uplift Asia's economic growth moving ahead. So if I were to direct your attention to the chart on the right-hand side, which is the Citi Economic Surprise Index for the Asia Pacific region, you'll find that the index itself, whenever it goes above 0, it means that the majority of the indicators are going ahead of consensus. And that is what we clearly see since early October, where most economic indicators are in fact beating consensus expectation. And again, this is a good, clear reflection of fundamentals, economic fundamentals, in fact, for ASJ economies that they're actually picking up and improving quite rapidly. So after mentioning some of our key regional markets, so here is our list of top single market equity picks for the year. So in summary, the top 5 markets that we favor are China, Hong Kong, South Korea, Indonesia, as well as Brazil. And you may notice that Brazil lies here and is an outlier because it is the only EMX Asia equities here. But in fact, it reflects our view that investors can diversify and should diversify into EMX Asia when the global economic recovery gathers pace. And because of that, we are seeing huge attractive opportunities within this EMX Asia region, such as Brazil as well as Russia. So having tackled the equity outlook, so we're moving towards the fixed income outlook now. So for fixed income outlook, we can see from this slide quite clearly that government bond yields over the past 40 years have sunk dramatically, and especially so over the past 5 to 10 years. So our view for rates is that while policy rates itself are unlikely to sink much further, we also believe that it's unlikely to rise this year and to a certain extent the next year as well. So in fact, what this means is the low rates environment itself should persist for the next 1 or 2 years. And with that said, if you can take a look at this chart right here, across the different fixed income segments, yield levels have been rather paltry. And if you can compare against the historical mean itself, most of the segments remain below the historical mean levels. And if you to compare against what we've seen during March last year, it is certainly a mile away. So with that said, with the low interest rate backdrop in mind, that tilts our preference for the fixed income classes towards high yield over the investment grades. And our decision is also supported by 3 fundamental dynamics, like number 1, the aggressive search for yield, number 2, a rising risk appetite, and thirdly, an improving economic and credit fundamentals for corporates as well as sovereigns. So with that said, here's our 3 picks for the top fixed income segments this year. So broadly speaking, we favor Asia high yield because of its above average yield and spread, as well as a good yield pickup. We also like it because of the spread itself more than compensates for default risk. So what this means is that the implied default rate from spreads right now is pricing in about 4 to 4.5% of default rate, while the actual forecasted default rate itself should come in about 2.5% or 2 to 3% this year for Asian high yield segment. And in fact, in the worst case scenario, we are projecting about 4%. So in simple terms, that means that the spread levels is offering more compensation for this default risk that we are expected to take for the Asia high yield segment. And the third reason, and one key reason why we like Asia high yield is because of its low duration of about 3 years. And I believe that as we go ahead, as we progress, we are likely to see the long end of the US Treasury rising further, and my projection is about 1.5%. So with that said, that means a certain level of interest rate risk. And with regards to that, keeping duration low for certain fixed income segments are really important right now for investors to mitigate that kind of interest rate risk. And I think Asia high yields, they're able to perform that well by having a low duration of about 3 years. And moving to the EM hard currency, a key reason why we favor that is because of its attractive upside from spread compression, and a large reason for that is because of its spread duration, high spread duration of about 8 years. And another key reason why we favor that is because of its improving economic and credit fundamentals for its issuer as well. So similarly, for EM local currency, we like it because of its improving fundamentals for the issuer. It also boasts a low default risk. And thirdly, for EM local currency, while we believe that the total return itself should come minimally from spread compression, but the attractive part of the total return aspect is that it should likely come from currency gains instead, because a lot of the EM currencies right now are really undervalued against the US dollar, and should that appreciate against the US dollar as we go along this year, I think that would in turn translate to attractive upside for EM local currency. So over the next couple of slides, I'll go through some of the key reasons why we favor each section. So starting right off with Asian high yield, I think Asian high yield, an inescapable fact that you first see is that it offers a beefy yield pickup. In fact, it offers a yield pickup of about 470 to 650 basis points over investment grade. And over its high yield counterparts, it offers a yield pickup of around 90 to 350 basis points. And this is important because yield pickup over the high yield is important in this prevailing yield starve environment, because this means that Asian high yield offers higher yield without the same credit, within the same credit ratings bucket, without the need to take on more credit risks. So that is really important in this prevailing low interest rate environment. But another important thing to note here is that the yield pickup is generally greater than what investors should expect from the historical level. And that again is significant in such a yield starve environment. So moving to the next key reason for Asia high yield, we see ample room for spread compression. And like I mentioned earlier, spreads right now is trading at around 650 basis points, and it is still above its historical mean level. And if we were to expect spreads to fall all the way to pre-COVID level of about 450 basis points, which is a reasonable expectation based on the prevailing macro outlook, we see that there is still ample room for spread compression of about 200 basis points. And what this will translate to is a attractive potential upside for total return. And moving on to a key reason why we favor EM debt is when we compared the spreads across the different fixed income segments, we'll find that spreads level right now for most segments itself are in fact below the mean level, and a lot of them are in fact trading at the lower end of a 10-year range. And there's only three segments within the higher yielding sleeve of the fixed income that really stands out to us as cheap. So these three segments are Asia high yield and EM debt. And overall, we see that, and we believe that these three regions are still cheap on a both absolute as well as a relative basis. So moving to my final reason why we like EM debt, I think a lot of it is underpinned on the EM growth, and we believe that EM growth itself, the outlook of EM growth itself is in fact turning rosier as we go along. As you can see from this chart right here, growth itself tends to rebound very strongly after a crisis, as highlighted here on the chart right here. And overall, a cyclical GDP rebound tends to be very strong and stronger than the historical average of 5.5%. And broadly speaking, we expect no difference from this year, as some of the indicators such as your PMI, your industrial production are really turning very positive. And with that said, that brings me to my last slide, which I would like to give an overview on today's outlook. So firstly, for the macro portion itself, we see constructive growth for this year, and we expect a vaccine-led cyclical recovery to be a major theme for the year. And for equities, we favor EM and Asia ex-Japan equities. And for our top picks, we favor China, Hong Kong, South Korea, Indonesia, as well as Brazil. And for fixed income, broadly speaking, we favor high yields over IG. And our top picks remain Asia high yield and the EM local and hard currency. And lastly, for asset allocation-wise, we have a preference for equities over fixed income, and we'll recommend a modest overweight for equities. So with that, I come to the end of my presentation. Thank you for your attention, and see you later.
Thank you, Colin. In this dynamic investment landscape, it is important to stay abreast with news and market happenings. Our mission at FSMOne.com is to help investors around the world invest globally and profitably. Whether you are seasoned or new to investing, you can always find fresh insights at FSMOne.com. In this session, hear from Catherine Chua, Assistant Manager, Investment Advisory at FSMOne.com, as she shares how you can access curated investment ideas, portfolio strategies, and more at FSMOne.com.
Good evening, ladies and gentlemen. My name is Catherine, and I'm from FSMOne Investment Advisory team. I believe we have heard a lot and digested a lot of information across the last few weeks of this event, and I hope this has got you motivated, or at least get you interested to kickstart your investment and spark some interest to investing. In this session, let me share with you the products and services on our platform and how you can make full use of our research materials to bring your portfolio to greater heights. So without further ado, let's get started. This is the overview of the content which I will be covering in the next few slides. At any point in time, if you have any questions, please type them in our events page at the bottom of this video, and we will get them and we will address them later in the Q&A session. So before I start, this is a little background to FSMOne. We were formerly known as fundsupermart.com, and our company was incorporated in Singapore in year 2000. We are a DIY platform, and we are the B2C division of iFast Financial Private Limited. One of our key milestones is being listed on SGX main board in December 2014. So over the years, we have expanded our business to Hong Kong, Malaysia, India, and mainland China, growing our group's asset under administration to 14.45 billion Sing dollar as of end of last year, December. We have increased the accessibility of the investment products to retail investors as well as institutional clients and clinched many prestigious awards. Today, our presence in the financial industry is recognizable, and with the same goal in mind in year 2000, we are always looking for new investment ideas for our investor, and so that you can invest globally and profitably. As mentioned, we are a DIY platform, and you can access your portfolio anytime, anywhere. There are products available here on the platform to help you consolidate all your investment holdings under one roof. So with a click of a button or just a swipe of a finger, you will be able to see a top-down view of your portfolio and rebalance your investments accordingly. As of all transactions are executed 100% online, all your historical trades can be downloaded into an Excel file, and our users can track their entry, exit price, dividends collected, fees paid, and so on. So with this orderly way of keeping tab of your cash flows and your profit and loss, it saves you the hassle of remembering multiple passwords to log into multiple platforms just to have a glance of how your investments are doing. So on our platform, you can trade in Singapore, Hong Kong, and US exchanges. And our transaction cost is only 0.08% for all exchanges. For selected SGX stocks and ETF, investor can use their CPF ordinary account and SRS monies to invest. You will also be able to participate in stocks IPO and ETFs IOP and be alerted of any corporate actions on your securities. You may choose to opt for scrip dividends or participate in rights issue or to register for EGM or AGM via your investment account. Even our CDP linkage form can be submitted online, and this allows you to sell your CDP stocks and ETF via our platform at the same attractive rate of 0.08%. Moving on, our research team has also created a list of stocks within the thematic portfolios, which seeks to identify and capitalize on long-term megatrends that will drive tomorrow's market. Some of these investment trends include aging population, China urbanization, millennials, digitalization of consumption, and smart cities. And for income and value investors, we have good news for you as well. There is a portfolio in this theme and category. Also, one of the common questions we get from investors is not knowing which ETF to pick, as there's thousands of them listed on New York, Hong Kong, and Singapore. So on our website, you will be able to find the ETF focus list, which will serve as a starting point to your investment decision. We have classified these ETFs in 6 broad categories, such as core equities, fixed income, country and sector-specific funds, as well as tactical play ideas. This list is refreshed yearly, and the funds are selected based on qualitative and quantitative factors, like this choice of underlying index, asset under management, expense ratio, tracking error, liquidity, and replication methods, so on and so forth. So to bring that further, we also allow investors to invest via a regular savings plan strategy. So let me explain more on the next slide. As markets do not go up in a straight line, investing in a regular savings plans allow you to dollar cost average and smoothen your overall portfolio return over time. We have 50 ETFs available on our platform, including tactical plays into China tech, global financial, semiconductors, cloud computing ETFs, and more. The minimum investment amount starts from $50 Sing dollar a month, and there's no minimum commitment period. Investor can choose to terminate and stop the investment anytime. And in line with this, what and where to invest, we are offering 0% waiver of the subscription costs for the next 6 months. So I think what's the best time to get started than now? Yeah, so apart from stocks and ETF on our platform, we also do offer bonds, ranging from retail bonds, wholesale corporate bonds, and Singapore government bonds. As a DIY platform, you can use the bond selector tool to predefine your search criteria for bonds, such as the bond duration, coupon, yield, and currency. And you can read out on all the important features that you need to know about them before investing, such as like the reset rate, coupon reset date, and so on and so forth. Yeah. So wholesale bond markets are actually pretty opaque in nature, where prices tends to be less transparent since they are traded over the counter, OTC they call it. What our platform aims to do is to eliminate this opacity and let you have direct access to the dealers to request for updated pricing of these bonds. Our bonds are quoted without markup, and this gives you the closer estimate to the live price. So simply just click on the request for quote button on the product landing page, and the dealing team will revert to you. Our team of fixed income analysts also publish a recommended bonds report on a semi-annual basis. So just last week, in this report we have just published, it covers the financial health of over 50 issuers and gives you a quick commentary on the bonds issued and which to consider. I would think that this certainly serves as a good reference to find out more about the bond issuer or guarantor and its credit health. This team of analysts also publish weekly updates and also developments and happening of the fixed income markets. There are plenty of articles available on our platform to educate readers and to empower them with knowledge and to make well-informed decisions and to take charge of your own investments. Also, you can be alerted when there is a new bond offered in the primary market, either via SMS or email free of charge. Lately, we have also set up a Telegram group under Bond Supermart, where you can follow daily updates of the credit markets. And if you like listening to podcasts, you can also find our podcast series called You Hunters on iTunes, Spotify, and Google Podcasts. Lastly, if you are an accredited investor, you can diversify your bond investment via our Bond Express platform. Instead of investing $250,000 per lot size, you can buy each corporate bond from just $5,000 nominal per piece. In this list of Bond Express bonds, there are credits issued by HSBC, UBS, OUE, Singapore Press Holding, Thomson Medical, China Evergrande, Oxley, and so on. So moving on to unit trust investments, just like the recommended bonds report, we also do a yearly review of our fund's choice. So this can be a starting point for a new investor if you don't know where to look at for the funds. So these funds that we actually cherry pick on the platform are selected based on merits. We look at quantitative factors such as performance, risk management, expense ratio. And there's also qualitative factors we consider such as the fund's consistency in investment approach and key personnel and stability of the management team. Our platform is also equipped with the tools for you to shortlist funds and also compare its performance with its selected index. This is useful if you wish to see if the active fund is able to outperform an index or comparing funds in similar investment space. There's also an online advisory to request that you can submit to get in touch with my team, and a short questionnaire will be prompted to find out more about your risk profile and also your financial goals. Having known all these, we can then propose something that is tailored for you. Okay, so right now, after going through so many products, and if you're still lost, fret not. We have a managed portfolio where we will do the homework for you and invest on your behalf. Our dedicated team of portfolio managers and research analysts study the full spectrum of unit trusts and ETFs to select the right products for your portfolio. We monitor the portfolio daily, digesting global financial and economic data, event, and also leverage on our regional research team for more in-depth analysis and insights. So unlike other robo-advisors out there which invest mainly in ETFs and uses algorithm to rebalance the investment, this portfolio holds mostly active managed funds like the unit trust investments. And we play an active role in selecting and weighing each of the individual products. Our valuation-driven approach helps us to uncover value, and there's research done behind each and every decision and moves. So on a quarterly basis, we also do conduct webinars to inform you of the changes in the quarter and also how we are positioning your portfolio moving forward. Also, as a part of the cash management solution on FSMOne.com, your investment account automatically comes with a multi-currency cash account, which function like your trading wallet. In this wallet, you can store various trading currency and do a currency conversion using live FX rates on the platform. Dividends collected can also be kept in their original currency, and these cash do use the basic interest rates. So taking things further, we also have introduced this account called the Auto Sweep account. So FSMOne basically manages this on a discretional basis for you. An investor can opt into this account and deposit Sing dollars into this Auto Sweep account and earns a projected yield of 0.688%. Monies kept in this account can be used to pay for all investment products mentioned earlier without any lag time. So sales proceeds and dividend income collected in Sing dollar will also be automatically deposited here to earn the extra yield in such low interest rates environment. Yeah, so you might be wondering how we actually deliver the 0.688%, right? So our secret is in the very next slide. When you top up your money into this account, we will help you to manage the funds that's inside here. And as you can see, instead of keeping 100% in cold hard cash, where yields only base interest of 0.03%, we help you to invest 80% of it. We deploy them into very safe segments of the fixed income market, like money market funds and short duration bond funds. Money market funds such as Fullerton SGD Cash Fund deposit Sing dollar in various banks' short-term fixed deposit with most placement period of less than 4 weeks. And this fund is extremely liquid. The short duration bond fund of our choice for this cash management account invests in high quality bond portfolio with an average credit rating of A-. The weighted duration of the fund is about a year's time, and the last 20% of your monies will be safeguarded in cold hard cash. So in summary, this three-part composition forms the Auto Sweep portfolio. It allows your idle cash to compound returns while waiting for investment opportunities in the markets. As these funds are highly liquid, you can use them anytime and deploy them into your investment products on this platform. And even if you invest in non-Sing dollar, the amount will be earmarked and be converted automatically for you after your trades has been executed. So late last year, we have also revamped our mobile application. It is actually very easy to use, and we highly recommend you to download our mobile app on either App Store or Google Play Store. You can scan the QR code in this slide, or you can just search the App Store for FSM Mobile. Not only you can track your investment portfolio or create a watch list for all your different securities, you can also browse our latest research articles by clicking on the research icon. So I would like to draw your attention within this research icon. We do have this thing called the star rating report, where you can click on each of the various countries, regional markets to view our investment outlook and how attractive this segment is. This page is actually updated quarterly, and during the star rating exercise, the team looks at key valuation metrics like PE, PB ratio, expected earning growth, as well as expected earning yields to determine how attractive a particular market is. So 5-star represents the market being most extremely attractive, and we will recommend overweight position in these markets. So currently, our top picks are, as mentioned by our colleague earlier, Colleen, lies in China, Hong Kong, emerging markets, and Asia. So at this point, you might be thinking that there seems to be a ton of information to digest, and you may not have the time to keep up with all these information. So I do encourage you to join our Telegram group, as it allows you to digest daily news in bite-sized bullet point form. Within each message bundles, there are also links to various research pieces should you wish to find out more. So you can head to the Telegram app and join us and get updated today. So lastly, if you wish to have a chat with us regarding how to construct your portfolio or hear our latest view on the current market outlook and investment ideas, please feel free to reach us via any of these methods, and we will surely get back to you. Should you prefer a face-to-face appointment, do come to our office at Raffles Place, and we urge you to schedule an appointment ahead of your visit. So with this slide, I shall end off my presentation for this evening, and thank you for your attention, and I'll hand the time now back to Geraldine.
Thank you, Catherine. We'll now take a short break as we head over to our speakers at the Q&A panel. If you haven't already done so, you can leave your questions regarding the presentations for today in the Q&A function. We'll be back with you shortly. Welcome back, everyone. Joining us here on the panel to take your questions will be Catherine Chua, Assistant Manager at FSMOne.com, Timothy Ho, Managing Editor and Co-founder, Dollars and Cents, Colin Low, Senior Analyst, Macro Research, IFA Singapore, and moderating this session will once again be Jean-Paul Wong, General Manager, FSMOne.com, Singapore.
Thank you, Geraldine, for your introduction, and welcome to the audience again for this panel discussion to wrap up day 5 of FSMOne's Why and Where to Invest 2021. So I'm looking at the questions that you have been sending to us, and I think the question that has been the most popular by far so far, it's this question. So I'll run through it. We know that we should be disciplined in investing, and time in the market is more important than timing the markets. So nevertheless, there are times that it is not a sin to take profit. When is such a time? So I'll bring in perhaps Colin to answer this question on when is such a time. What are some of the things that as an investor perhaps we should look into and consider?
I think a major thing for investors is to understand fair value. So for different people and different crowds, fair value does mean different things. But I think for the layman investor, fair value itself, I think it means they have to do some homework, some due diligence, and decide at what number and what price is this product or this security at your fair value. And to come to that fair value, I think there are several considerations, such as the fundamental aspect of a security of a product, such as the earnings growth, the valuation levels, as well as some of the sales growth and growth numbers. So overall, I think once we derive to the fair value, then it tells, compare that to what the prices is saying right now, what the market is saying about the prices, and you will be able to define in a more quantitative fashion, is the product itself or is the security itself worth cashing out, worth taking profit.
Yeah. How about Catherine? You have a lot of clients that probably ask you this question often.
Yes.
So when's a good time to take profits? When is a good time to enter the markets and so on, right? So how do you tackle that?
I would say the first and foremost, you have to ask yourself, why are you taking the profit? Is it because something has deteriorated so much on the company's fundamentals, or be it the sector, the trend, or something like that? If you ask yourself that question, it justifies you taking profit or if not cashing out of these investments, then I think it should justify the means. And also the very next question, I think very important to ask yourself is, what are you investing next with this money? Are you just going to sit aside and just hold cash? So I think these are all these considerations. So of course, it's like dieting. You have to be disciplined. You can have cheat meals once in a while. So I think taking profit is something like your cheat meals. So you can lock in some profits, perhaps sort of in a fashion of rebalancing your portfolio. Put them into very more secure segments to lock in these profits.
Yeah, I think that's a good point. So Timothy, how about you? When you look at markets, is there such a thing as a good time to take profits?
I think it depends on your aim and your long-term plan, right? Because the markets are always going to be moving, so there will be stocks. Good companies are going to be overvalued at times, and sometimes they're going to be overvalued before they become fairly valued. And I think if I would exit a company if I really don't like it, regardless of whether it's on a profit or on a loss. It's not because there's a profit, let's take some money off the table, but it's not because there's a loss, let's just stay in there. I think if you don't feel like the company is the right company for the kind of portfolio you want to own, maybe it's worth reconsidering whether you should have. That said, I think there is a possibility that sometimes certain companies that we invest in a portfolio, a certain company might just jump or triple or go up 5-10 times, in a year, which I think we know who are they. And do you really want your entire portfolio to be built? You might be making a lot of money, but do you really want, let's say you got a portfolio of like $500,000 right now, and that's because one single company that has done well over the past 12 months. Do you really want the entire portfolio to be based on 90% on just one company? I think probably not, and that's where you might want to exit a little bit of your position, redistribute your assets, your investment portfolio across different companies that you feel you also want to invest more in.
Yeah, I think it's very true. And just to add to what my panelists have shared, I think if you look at the managed portfolios that we have in-house, for example. So, last year, I think the team introduced digital economy into the portfolio via an ETF, which is the OGIC. And it's done very well. So, of course, it may seem like a wise decision to just keep that position, right? But I think what the team has looked into is to actually trim and take some profits from that position in digital economy because of that run-up, which is so much higher and sharper than the other sectors, right? So its allocation has also gone up relative to the other positions in the portfolio, and therefore taking some profits because of that. And also, of course, linking back to what Colin shared about whether the valuation of that sector has become too expensive or not. And I think in the case of digital economy, clearly the answer is a yes. And then going into other undervalued sectors, for example, the financial sector. So I think from a portfolio perspective, it gives a lot of perhaps clarity in terms of what should be the next step, whether it's to take profits or add positions into the cheaper sectors and so on. So I'll move to this also popular question, which is I think related to what Colin has shared, regarding the US dollar weakening. So would it still be wise to invest in the US market or stocks denominated in US currency? Value of investment could diminish with the weakening currency. How would you tackle this question, Colin?
I think first we have to examine the US dollar dynamics itself. So broadly speaking, we do hold a view that we expect a US dollar bear market over the next couple of years. But I think one thing I'd like to mention right now is the short position for the dollar itself is in fact very, very high. And I mean, when it comes to this kind of levels, it might be some kind of reversal, possibly hovering in the near term. And I think that itself highlights the fact that the dollar weakening is not going to be a smooth one-line trend. In fact, it will be many ups and downs. And while across history, dollar weakness tends to be more front-loaded, but it tends to not be quite well distributed over the past 5 to 7 years. So with that said, I think we cannot base on the view of dollar weakening over the next couple of years to be a deterrent for us to invest in some of these markets, such as those denominated in US currency. Because I think a lot of the gems, in fact, lies in the US market, especially those listed in the US. And your total return, the total return appreciation could possibly outweigh your currency depreciation. And with that in mind, I think it's not enough of a deterrence to exit position from your dollar denominated the equities or even some of the securities.
Yep. Thanks, Colin. I'll tackle this next question, which is more from a portfolio construction kind of angle. So if we have $10,000 of capital, how long and how much do we apportion for dollar cost averaging? I'll invite Timothy to share your views a little bit on how to tackle this question.
Yeah, I think the idea here is that you want to stay vested across time. You don't want to have periods of time, like say a year or so, where you're not investing at all, right? Because if that happens, then potentially you might miss out on a bull market run or a couple of great days in a certain decade that you just missed out on because you didn't invest. So I think the correct way to think about it is, how long would the 10K of capital last you? Are you replenishing it, or is it like you have 10K and that's going to be for the next 5 years? Because if that's going to be for the next 5 years, then you probably want to stretch it out. I mean, it's not a lot of money, $2,000 a year, right? If it's 5 years, and that's about $200 a month. So that's not a lot, but that's still a good start. But if you're going to have like 10K that you want to invest every year, let's say, then it's then I would just divide it by 12. 10K divided by 12, that's about $800 a month. And then next year you have another 10K, maybe that's from your bonus, and then that's how you distribute it. So I think one of the things that, it's the start of the year, so some of us have gotten our 13-month bonus or more than that, right? And you might have that $5,000, $6,000 extra, and it's very common to, hey, you know what? Let me quickly invest the money in, which I know it's normal. Every day you see the asset prices going up, you feel like, why are you holding back? But things can go south, as we have seen in 2020, and when things do go south, you would wish that you had distributed your investment money across the year. And I think, if 10K is what you have for the year, I would just divide it by 12.
Yeah. How about you, Catherine?
I have a slightly different view from Timothy, but I do agree with what he says about whether or not do you foresee yourself having more income in the future to sort of top up this 10K of investment. But then should 10K is only all I have for the next couple of years with no bonus or no other spare funds to invest, I would actually want to do like a 50-50. But of course, I don't think there's like really a right or a wrong answer. But I think I'm those kind who feel a little bit FOMO, so I think I will just keep 50 and not invest them first, and the remaining 50 I'll just layer it in across like maybe the next couple of months, because I don't believe that markets will go up in one straight line. There will definitely be corrections, or even like just a mini like a maybe 5-6% drop down. So I think that gives me a safer margin of entry, so that I won't regret on sitting on the fence and miss out on the bull run.
Yeah.
So this is how I will adopt that approach.
Yeah, sure. Thanks, Catherine, as well. So let me look into this next question. So I think it's something that Timothy brought up in his presentation, something about the STI being a laggard, but I still make money. So condition, if you enter at the right time and start DCA, started in June, so I believe it's probably last year, and seeing pretty okay gains. So maybe I can just rephrase this a little bit. So home market bias, I think we were talking a little bit about it. A lot of investors, even in the poll that we did, I think a lot of them chose Singapore as the first investment they have made or they will make. So when it comes to Singapore, of course, when you compare to some of the other markets, it's been indeed a bit of a laggard, but how should we look at this market in terms of perhaps maybe firstly outlook, and also secondly in terms of the strategies? So is the DCA the way to go for it? So Timothy?
I definitely think DCA is a better way to go personally, and I think during my sharing I make the point that had you DCA, like the gentleman who asked the question, had you DCA into the market in 2020, even for the STI, you would have made money, and that's good to know, considering that the STI didn't have a really good year in 2020. I think with regards to home market bias, I think it's very normal in anything we do, right? So in the past, when the world is not so global, we eat Singapore food, we tour around Singapore. That's the place we go to, the Singapore Zoo. We invest in the Singapore companies. But I think in an increasingly globalized world, which obviously has been hindered significantly by COVID, it makes sense that we are exploring things outside of Singapore. So now we are traveling. Before COVID, a lot of us spend our leisure time outside of Singapore. We try food from other countries, right? And it makes sense that we also invest in other countries as well. And the fact of the matter is that a lot of the growth opportunity in our generation probably would reside outside of Singapore, right? Singapore is a developed nation. We have stable blue chip companies, and those guys may give us good dividends, but a lot of the growth opportunity is going to be outside of Singapore. And if we don't invest outside of Singapore, chances are that we would miss out on some of the growth opportunity in the next decade. So, but yeah, I guess it's normal to want to invest in Singapore. I think it's important to invest in companies, So I think right now, I know that in 2020 a lot of people started investing, and there's a lot of people investing in stuff they may not know that much about. I think it's important to invest in companies we know, and that's why I guess home buyers sometimes exist.
Yeah. Colin, do you have anything to add, perhaps on what's lying ahead for the Singapore economy in terms of outlook?
For the Singapore economy itself, I think the economy is rather tethered to the Asian economy as a whole, and specifically for China. And I think a lot of what we have been seeing from the numbers coming from Chinese economy, particularly the money supply, particularly from the imports demand, I think that is driving a lot of exports for Asian economies, as well as some of the money supplies, allowing all these Asian economies to see better earnings growth. I think in a way, Singapore markets benefit, and not all companies benefit, but a lot of those companies that have a greater revenue exposure to China, as well as some of the Singapore companies actually benefits. So I think broadly speaking, while the economy itself is lagging several of the North Asian economies, but Singapore is at a sweet spot where it benefits from some of these trends, such as your global manufacturing upcycle and your tech upcycle, and all these are driven by the North Asian economies, particularly China. I think so. To sum it up, Singapore's economy itself is a big beneficiary of this kind of trend, and therefore moving ahead and with us entering phase 3 now, I think the prospect looks indeed more rosier as compared to some of our neighboring markets.
Yeah. I think this question, Catherine especially probably gets that quite a lot from the clients you interact with. So I'll put up this question. So yeah, the $1 million question is a market crash really coming in this year? And should we be concerned? What should we do?
Yeah, so yes, and definitely I do get this question a lot from my clients. In fact, some of them are actually telling me, yes, I think market is crashing and I'm not investing. So, but I do think there's really opportunity cost while waiting at the sideline. So I think hence, I think today the whole message is about dollar cost averaging. Time in the market matters more than timing the market. So I think as an investor, you should not be concerned or if not wavered due to there's a steep correction or what. And in fact, Warren Buffett has always said, be greedy when everyone is fearful. So I think I would be more than happy to part with my monies, especially when I see deep corrections, because it's like telling you, Sephora is going on a 50% sales. I'm going to wipe all the makeup products there on the shelf because you know the value of these products. You know how much the foundation costs. And if you do see such deep corrections, I'll be more than happy to stock up on some of my favorite companies, and some of the favorite sectors or funds. Yeah, so in that point of view, I do have a watch list of stocks and ETF and some funds that I would actually like to add more should market actually correct. So I think this is one of the methods that I would be prepared for a correction. And also additionally, I will add into fixed income funds for the time being, because I do think that fixed income markets don't actually have a very huge drawdown compared to equity markets. And like what Timothy shared earlier in his presentation, that allocations to bond, cash, and gold is actually very important as well and should not be neglected. Yeah.
And Timothy, what is your crystal ball showing for this year? Is there a crash coming?
I think it's a very, very important question, and I think that personally I would want to keep some ammo, which means that if the opportunity comes to invest because of a market decline, I think we got to keep cash. I think you can't. Personally, I don't think we should be 100% invested, which means you have no savings, you're just putting everything in investment right now. I think that's dangerous. I think I would keep some cash, maybe a bit of asset allocation. So if you are worried, you keep some money in some of the cash accounts and stuff like that. I feel like in terms of, I think one of the things I want to spot on is that I still can clearly remember March 2020 because that's just 8 months ago, right? And here's the thing, right? With a market crash, the assumption is that you will invest in a market crash. But then those same questions quickly change to how low can it be? And what happened in 2020 we learned is that the market can crash quickly, but it can recover quickly as well. And I think what was happening and I hear this from a lot of even my fellow investment bloggers and stuff like that, is that a lot of people was very, very surprised by how quickly the market recovered. They thought they would go a bit lower. Yeah. Some of them have started DCA into the market, so that's good. But they could not believe that by May, June, the recovery was more or less there. And I think if for people who are waiting for a market crash, the question is that if a crash do come, are you going to invest immediately or are you still going to wait some more, right? Because if you've waited so long for a market crash and it finally comes, there is a good chance you might wait some more.
Yes.
Yep.
Yeah, staying out on the sidelines, lah, which may be a problem, especially based on last year's experience. Yep. I'll put up this question that's addressed to something that I shared in my presentation. So given the early parts of the economic recovery cycle that we're looking at, so would I recommend an overweight in small caps and commodities? I think for small caps, I mentioned about Asian small caps in terms of the position that I have in my portfolio. And I think in terms of Asian small caps, why it's interesting, yes, because of the recovery that we're expecting, and in terms of also the valuations. I think our research team has written recently about the valuations for Asian small caps looking quite attractive, especially versus the US and European small caps, in fact. So from that perspective, I think I was comfortable to then therefore look at Asian small caps. The other part of the question, of course, is related to commodities, something that I think Colin has also shared about in terms of how some of the economies in emerging markets especially could benefit from commodities and the US dollar depreciation that you mentioned. So how would you look at commodities? Maybe I'll bring you in, Colin, to talk about that.
Yeah, sure. I think in general, I hold a very favorable view on commodities now. As I alluded just now earlier in my presentation, that I do believe that we will see a commodities upcycle this year. I think two key factors drive it. Firstly, it is the dollar weakness. And overall, if you look at across history, you see a tight correlationship whereby whenever dollar drops, commodity prices rises. And I think a lot of the factors driving this is because I think commodity prices, a lot of them are being priced in the greenback, and therefore I think cheaper dollar itself means commodity demand picks up. And the other reason driving commodity prices is a supply-demand mismatch. And overall, if you look at the supply side for commodities itself, you'll find that the capex has been weakening over the past 10 years. So what this means is over the past 10 years, there will be underinvestment into the commodity complex, and therefore what we've seen lately is there's a drawdown in inventory, and this drawdown inventory is quite unusual in this early in the cycle. And because of that, when we look at the demand side itself, we expect a better than expected demand recovery coming from a cyclical global recovery. So with this low inventory as well as potential upside in the demand, we are seeing some aspect of a demand-supply mismatch playing out. We think, and I believe that this will gradually play out over the years. So broadly speaking, these two factors will be driving commodity prices. And I think a good example is when you look at the industrial metal prices, where we see particularly copper as well as your iron ore has risen so much over the past years. And I think that is also a reflection of the optimism behind the global economic recovery. I think that is a good example of how much and how fast commodity prices can go in a year. I think we will see that plays out more over this year as well.
Okay, thanks, Colin. So I'll perhaps move on to a little bit more on fixed income. And we have a question here from one of our investors. So with the yield, I guess low interest rate environment, and how does this affect the fixed income strategy, or what fixed income products should we look into? So perhaps I'll just invite Kat to just share a bit of your views in terms of fixed income with clients. Yeah.
Yeah, sure. So with yields going up and also interest rates environment being very, very low, I would actually suggest clients to actually look for a yield in a risk-reward perspective. So I think Colleen actually mentioned earlier in his presentation, we do see cheap valuation within Asia high yield bonds and also the EM debt space. So I think on top of these two fixed assets, as in fixed income assets, we also do recommend overweight onto like short duration bond funds because I think itself is very, very low volatility and it allows you to deploy cash quickly as well should market turns and you want to just layer in your last bit of ammo or your little spare cash when market corrects. So I think one of the products that FSMOne has on the platform is the cash management account, the auto sweep account. So itself, it does give a 0.688% projected yield. So I do think it's quite a pretty safe place to park my money, and it does give me decent returns as well. And I do have that instant reaction. Should I need to park monies into the equity markets, I could immediately layer in and queue my stocks. Yeah. So other fixed income products, assets, I actually do like are actually from the unit trust space rather than like ETF space, because I think most of the ETFs, especially the more liquid ones, they are listed on New York or NASDAQ. So these actually pays dividends, these fixed income funds, and the withholding tax could actually erode away my returns and yield. And also investing in US listed securities, it will be in USD, and should US dollar further weakens, it could actually erode my yield more. I mean, compared to investing in New York or NASDAQ listed stocks related ETF.
Okay.
Yeah, so this is my investment strategy.
Yeah. How about you, Colin? Any perhaps a last word on fixed income in terms of the strategy we should be adopting?
Right, I think it's a good question, first and foremost. I think to tackle this question, a good selection criteria for investors is to look at the duration more in the scrutiny. So like I mentioned earlier in my slides, I think Asian High Yield is a good example. It offers a duration about 3 years. So lower duration will mean that the impact on prices coming from a change in yield itself will be relatively lower. So I think for investors looking into the fixed income markets, they can consider something of a lesser duration, therefore having a lesser interest rate risk. I think a high yield duration doesn't mean it's bad, for example. So take for the case of emerging markets high yield, or emerging markets hard currency. So it tends to have a duration of about slightly more than 8 years. I think this is high as compared to Asian high yield. But then again, if you were to assume yields broadly for the EM hard currency space contract, and that is because of spread compression outweighing the rise in yield. So we see a net contraction in yield. So if we were to expect that case, then and applying that to a high duration product itself, we can see significant compression gains. So this adds another layer of selection within the fixed income space. So firstly, I think it's important to overall consider a low duration product itself, but secondly, to look at the product itself, whether it has room for spread compression. And with that said, it doesn't mean that a high duration is a bad product. So I think that concludes my explanation for this.
Yep. That's a good point, Colin. Yeah, thanks so much. I think we've come to the end of our panel discussion. And thank you to the audience. Thank you to my panelists for all your very good views. And we wish you a very, very good year in terms of making more money, a profitable year in terms of investments. Thank you very much.
Thank you, ladies and gentlemen, for the insightful discussion, and to our audience for your questions. We'll now proceed to the daily quiz with 3 winners with the most accurate and fastest answers will walk away with $100 worth of FSMOne multi-currency cash account credits. To access the quiz, you'll need to be on Event Live. Click on Event Activities on the black menu below the video window. Under the agenda, look for the quiz schedule. Click on the Join Quiz button. The activity window will be displayed on your right. Once the quiz ends, a leaderboard will be displayed and you may check if you're one of the winners. If at the end of the quiz, the results screen shows rank 1, 2, or 3, congratulations, it means you're the winner. Are you ready? Let's start the quiz. A warm-up question. Which of the following is a type of product that is not available on FSMOne.com? Is it unit trusts? Is it cryptocurrency? Is it corporate bonds? Or is it exchange-traded funds? And the answer is option 2, cryptocurrency. Now that we're all warmed up, we are ready for our final quiz. Question number 1. To survive when investing, what are the 3 O's mentioned by dollars and cents? If you're a huge fan of the TV show Survivor, this question might be a no-brainer for you. And the answer is option 1, outwit, outlast, and outplay. Congratulations to 50% of us. If you're ranked in our top 3, good job, keep it up. If you're not, we have 4 more questions to go, so plenty of chances. Question number 2. Which of the following refers to the 5-step framework mentioned by Budget Babe? Remember, we're looking for the fastest and most accurate participant, so think carefully and act fast. And the answer is option 4. Capital, goals, risk and emotions, time, and strategy. Question 3. Which of the following are not equity markets that FSMOne.com favors for 2021? Option 1, South Korea and Hong Kong. Option 2, China and Hong Kong. Option 3, Indonesia and Brazil. Option 4, Thailand and Brazil. Our top 3 winners will walk away with $100 worth of FSMOne multi-currency cash account credits. And the answer is option 4, Thailand and Brazil. Good job. Question 4. Which of the following is not available on FSMOne.com? Is it fund fact sheets, stock screener, automated ETF recommendations, or recommended funds or bonds report? Ms. Catherine Chua just shared this with us not too long ago, so hopefully the information is still fresh in our minds. And the answer is option 3, automated ETF recommendations. For those who are not in our top 3, we have one final question to go. So one final chance. Get ready. Question 5. Which of the following is a benefit of a regular savings plan? And the answer is option 2, disciplined way to invest by using dollar cost averaging. Who are our lucky winners? If your result screen shows rank 1, 2, or 3, remember you must take a screenshot showing the whole activity window. Ensure your rank, score, and nickname are captured clearly. Then email the screenshot and also include your name, FSM account number, and the daily quiz date to events@fundsupermart.com by 31st of January to claim your prize. And now, for the moment many of us have been waiting for, it's time for our lucky draw. So for all our winners, do remember to screenshot the video's entire display with your winning name shown clearly and email the screenshot with your name and FSMOne account number to events@fundsupermart.com by the 31st of January 2021. Okay, let us reveal our lucky 10 winners who will receive $100 worth of FSMOne multi-currency cash account credits. Congratulations to all 10 of you. So next up, it's time to find out who our grand prize winner for the lucky draw will be. Walking away with $1,000 FSMOne AutoSweep account credits. The winner is... Congratulations, meeting! Thank you guys for your participation. We have really enjoyed your presence throughout this event. That is all we have for today, but what and where to invest is not over. Join us on the 26th of January 2021 at 7 p.m. for a special Chinese session. It's goodbye for now, and don't forget to check out the rest of the promotion FSMOne.com has launched in this period. We hope to see you on the 26th of January at 7 p.m. Thank you and good night.